Fear is gripping the markets today. With U.S. debt soaring past $35 trillion, investors are left wondering, how much risk is too much? Is your portfolio truly protected, or are you about to face the harsh reality of a financial storm? Today, we're broadcasting live from Washington, D.C., right outside the U.S. Department of the Treasury, where trillions of dollars are at stake. This building symbolizes control over the nation's finances, but can even the Treasury hold back the tidal wave of debt that's coming?
The markets are on edge. The once reliable bond market is faltering under the pressure, and investors are starting to panic. Bonds, which have been a safe haven for decades, are now facing their worst decline in 40 years. Inflation, while cooling, is still above the Federal Reserve's target. And with debt rising fast, it's no wonder people are pulling out of bonds and moving into safe haven assets like gold. Today, we'll break down what's driving this fear and how you can avoid getting caught in the crash.
That's right. We're diving deep into the debt crisis, but it's not just about the numbers. It's about how fear and greed are fueling decisions across the market. Investors are torn, take risks for higher returns or flee to safety. In this episode, we'll cover the critical moves you need to make right now to protect your wealth and navigate the rising uncertainty.
Stick around as we dive into the latest news, expert opinions, and real-time reactions from social media. Fear is everywhere, but those who understand the market's psychology and can harness both fear and greed will be the ones who come out ahead.
And as always, we'll be answering listener questions later in the show, addressing what moves you should be making in this volatile environment. If you're wondering whether you should be dumping bonds, buying gold, or holding cash, stay tuned.
So, hit that subscribe button and get ready to arm yourself with the knowledge to survive and thrive in today's market. Let's dive in. Let's get straight into the heart of today's issue: rising U.S. debt and the persistent pressures of inflation. As we mentioned, the U.S. national debt is skyrocketing, now surpassing $35 trillion. This isn't just a number anymore. It's a critical factor that's shaking the foundation of both the bond market and the broader economy.
Exactly. Government spending has soared over the past few years, driven by massive fiscal stimulus packages and growing federal programs. But this kind of spending comes with a cost. The more the government borrows, the more pressure it puts on the bond market. And that's what we're seeing now. Treasury bonds, once considered one of the safest investments, are under intense stress.
The bond market is actually entering bear territory. Investors are demanding higher yields to compensate for the risks tied to the rising debt. With Treasury yields climbing, bond prices have fallen sharply. We haven't seen a bond market decline like this in decades.
And while inflation is starting to cool, it's still above the Federal Reserve's target, currently sitting at 2.5%. This means we're in a difficult spot. On the one hand, the Fed is cutting rates to stimulate the economy, but on the other, inflation is still eating away at the value of both bonds and cash.
Exactly. Moderating inflation may seem like a positive sign, but when paired with soaring debt, it creates an unstable economic environment. The yield curve inversion, where long-term yields are lower than short-term ones, signals a potential recession ahead, as investors move toward short-term safer investments to avoid the long-term risks of holding bonds.
The fear here is that the government's borrowing could spiral out of control. As debt continues to rise, the cost of servicing that debt, interest payments, will only grow, forcing the government to either raise taxes or reduce spending on critical programs. Both scenarios could slow economic growth, leading to further market instability.
Investors are already feeling the pressure. Traditionally, bonds have been a go-to safe haven asset during uncertain times. But now, many are questioning whether bonds can provide the protection they once did. Rising debt is creating cracks in what used to be the foundation of many portfolios.
Inflation is compounding the issue. While the Fed's rate cuts aim to stimulate economic activity, they're also making it harder to control inflation in the long term. If inflation remains stubbornly above target, investors could face a scenario where neither bonds nor cash provide enough protection.
All of this leaves investors in a tricky position. With debt rising, bonds faltering, and inflation still a concern, it's clear that traditional safe haven assets are underperforming. The question now is, what's the best move to protect your portfolio?
Now that we've laid out the challenges posed by rising debt and inflation, it's time to talk strategy. The big question on everyone's mind is, how do you protect your portfolio when both the bond market and traditional safe haven assets like cash are underperforming?
The key here is diversification. Investors can no longer rely solely on bonds for stability. Instead, they need to explore alternative safe haven assets, like gold and other commodities. Gold has been outperforming bonds recently, as it's seen as a hedge against both inflation and economic instability.
Exactly. In uncertain times, gold has been a reliable safe haven. With bonds faltering, many investors are now shifting their focus to precious metals like gold and silver. Even commodities like oil are performing well as inflationary pressures rise.
If you're looking for something similar to bonds, TIPS, Treasury inflation-protected securities, are a solid option. Unlike regular bonds, TIPS adjust with inflation, protecting your purchasing power even in high inflation environments.
And don't forget about dividend-paying stocks. While stocks come with their own risks, dividend-paying stocks, particularly in defensive sectors like utilities and consumer staples, can provide a more stable income stream during volatile market periods. These sectors tend to be less affected by economic downturns and offer some insulation against market shocks.
Right. It's important to remember that not all stocks are created equal in this environment. High-growth tech stocks, for example, may struggle with rising interest rates, while defensive stocks like those in healthcare, utilities, and consumer goods are likely to fare better. They provide consistent demand, regardless of economic conditions.
Another strategy is to reduce exposure to long-term bonds. With yields rising, long-term bonds are particularly vulnerable. Shorter duration bonds or corporate bonds with higher yields can offer better protection in a rising interest rate environment.
For more aggressive investors, there's also the option of alternatives like real estate or cryptocurrencies. While riskier, these asset classes can provide significant returns if handled carefully. Real estate, for instance, can serve as an inflation hedge, especially in sectors like rental properties where demand remains strong.
The key takeaway here is that diversification is your best defense. In a high-debt, high-risk environment, spreading your investments across multiple asset classes, commodities, dividend stocks, short-term bonds, and alternatives will help mitigate risk and provide more stability in uncertain times.
Absolutely. Sticking with just one type of asset, whether it's bonds, stocks, or commodities, isn't a winning strategy right now. Diversification is crucial, and having a mix of safe haven assets and growth opportunities will keep your portfolio balanced and ready for whatever comes next.
And remember, this isn't about panic. It's about being proactive and adjusting your strategy to fit the current market realities. The financial landscape is changing fast, and those who adapt quickly will be in the best position to weather the storm.
Exactly. So take a hard look at your portfolio, diversify where needed, and don't be afraid to explore new opportunities like gold, TIPS, or dividend-paying stocks. Staying flexible and informed will make all the difference. Social media is buzzing with real-time discussions about the rising debt and market instability. Here at Finance Frontier AI, we've been actively engaging with our audience, sharing insights and gauging reactions. Let's dive into some of the most impactful tweets we've shared since our last episode and what they tell us about investor sentiment.
One of our most shared tweets reads, "Fed cuts rates for the first time since 2020, sending shockwaves through markets." While stocks rally, experts warn of looming inflation and recession risks. Will this spark growth or set the stage for economic turbulence? This tweet sparked a lot of conversation. Investors are clearly torn. Rate cuts typically boost markets, but with inflation still lurking, many fear this is just a temporary fix.
Exactly. What's interesting is how investors are reacting to the Fed's rate cut in different ways. While stocks may be rallying for now, the long-term risks haven't disappeared. Our tweet also highlighted a key shift. Treasury yields are dropping as investors flock to bonds for safety. This shows a level of caution among more conservative investors, even as others jump into the stock market rally.
Another tweet we shared that really resonated was, with Treasury bonds struggling, gold continues to outperform. Is it time to rethink your safe haven assets? This one got people talking about alternatives to bonds, and we've seen a noticeable uptick in interest around gold as a reliable hedge against inflation and economic instability.
Gold has been a hot topic lately, especially as bonds have faltered. Our audience has been shifting their focus to precious metals, and that's reflected in the response to our tweet. Investors are clearly looking for something solid to hold on to in this volatile environment, and gold is filling that role. The message here is clear. Safe haven assets are evolving, and it's time to rethink traditional strategies.
We also posted, stagflation concerns are on the rise as inflation stays high while economic growth slows. Defensive moves are essential. Is your portfolio ready? This tweet highlights one of the big fears among some investors, stagflation. It's a combination of high inflation and sluggish growth, though opinions are mixed on whether it's a real threat right now. Defensive sectors like utilities and healthcare are seeing more interest as a precaution.
That's right. Defensive sectors are gaining traction because they tend to perform better during economic downturns. We've seen increasing interest in dividend-paying stocks and companies that offer essential services as people seek stability. The engagement on this tweet shows that investors are becoming more cautious, prioritizing income stability over growth in these uncertain times.
Another tweet we posted recently was, "Are bonds dead?" With yields dropping and inflation staying high, investors are turning to alternatives like tips and gold. This sparked a lot of debate, with some arguing that bonds still have a place, but many more pointing out that the combination of inflation and falling bond prices is pushing them to explore other options like tips, Treasury inflation-protected securities.
Tips are becoming a critical part of the conversation, especially for those who still want the relative safety of government-backed securities, but are worried about inflation eroding their returns. Our followers have been quick to pick up on this, and we're seeing more and more people considering inflation-protected securities as a way to navigate rising prices without fully abandoning bonds.
And finally, one of the more forward-looking tweets we shared was, as markets brace for volatility, keep an eye on alternative assets like real estate and cryptocurrencies. Diversification is key to surviving this storm. This tweet highlights an important trend. Investors are not only diversifying into gold and tips, but also exploring more unconventional assets like real estate and even cryptocurrencies. While riskier, these options offer significant upside potential in an uncertain market.
Exactly. Real estate has long been a hedge against inflation, and we're seeing renewed interest, especially in rental properties and commercial real estate. Cryptocurrencies, while volatile, are also becoming a part of the diversification strategy for more aggressive investors. Our tweet reflected this shift in sentiment, as investors look for both stability and growth in non-traditional areas.
What we've seen across social media is a growing sense of caution, but also an acknowledgement that smart diversification is key. Whether it's moving into defensive stocks, rethinking bonds, or exploring alternatives like gold and crypto, the message is clear: the old rules don't apply in today's market. Adaptability is what will keep portfolios strong.
Now that we've covered the real-time reactions on social media, let's dive into what the experts are saying about the rising U.S. debt and the bond market's instability. There's been no shortage of warnings from economists and financial analysts about the long-term implications of the current debt trajectory.
One key expert, David Kelly, chief strategist at J.P. Morgan Asset Management, recently stated, the Federal Reserve must strike a balance between lowering rates and controlling inflation. This highlights the complexity of managing high inflation while dealing with massive debt, and how missteps could lead to long-term economic instability.
Another critical voice comes from Claudia Sahm, a well-known economist, who commented, the Fed's aggressive cuts could be a necessary evil to avoid a deeper recession, signaling that while rate cuts might help temporarily, they could fuel inflationary risks down the road. This is important for investors because it shows that there's no easy solution. Every move has risks attached.
Exactly. Investors are walking a tightrope. John Canavan from Oxford Economics has been closely monitoring the bond market and warned that front-end Treasury yields may need short-term corrections, meaning that while some bonds might offer short-term gains, longer-term risks remain due to potential inflation spikes.
The consensus among these experts is clear. Rising debt isn't just a government problem. It's spilling into every corner of the market. Peter Schiff, an economist, notes, this gold rally reflects concerns about the dollar weakening in a low-rate environment, further emphasizing that many investors are flocking to gold as a safe haven alternative.
With these warnings in mind, it's clear that diversifying away from traditional bonds is becoming increasingly important. Experts like Kelly and Sam are signaling that this environment is too unpredictable to rely on one asset class. Investors need to stay nimble and consider alternatives like inflation-protected securities, TIPS, or commodities like gold and silver.
The overall message from experts is that we're entering a period of heightened risk. Rising debt, potential stagflation, and bond market instability mean that traditional safe havens are no longer as reliable. Investors need to diversify and prepare for continued volatility in the coming months.
Absolutely. With inflation still hovering above the Federal Reserve's 2% target and bond yields reacting unpredictably, it's crucial to stay informed and be ready to adjust strategies as market conditions shift.
Before we wrap up, let's answer a few questions from our listeners. As always, these questions give us a chance to dive into specific concerns about navigating the current market environment. Our first question comes from Rebecca in San Francisco. With bonds performing so poorly, should I just move everything into gold?
Great question, Rebecca. While gold has been a strong performer in these uncertain times, it's important not to put all your eggs in one basket. Diversification is key. Gold is an excellent hedge against inflation and market volatility, but you should still keep some exposure to other assets like shorter duration bonds or inflation-protected securities, TIPS. These can help balance out risk and provide a more stable return.
Exactly. Think of gold as a component of your portfolio, not the whole strategy. It's there to protect against volatility, but you should still consider defensive stocks or other commodities to round out your investments.
Our next question comes from Paul in New York, who asks, if the Fed continues to cut rates, should I be worried about inflation picking back up?
That's a valid concern, Paul. Rate cuts can lead to increased borrowing, which could push inflation higher, especially if the economy starts heating up. However, inflation has been moderating, and the Fed is closely watching it. It's all about balance. If inflation does start rising again, you'll want to have assets in your portfolio that can hedge against it, like TIPS or commodities.
One thing to watch for is how the Fed balances growth and inflation. Right now, they're focused on stimulating the economy, but as we've heard from experts like David Kelly, there's always the risk that inflation could reignite. Being proactive by having inflation-protected assets is a smart move.
And finally, a question from Laura in Chicago. Is it time to completely give up on bonds?
I wouldn't say it's time to give up on bonds altogether. While long-term bonds are underperforming, shorter duration bonds and corporate bonds with higher yields still offer opportunities. Plus, TIPS can help protect against inflation. The key is to be selective. Long-term bonds are more sensitive to interest rate changes, so focus on shorter-term strategies that provide more flexibility.
That's right. Bonds are still part of a balanced portfolio, but the days of relying solely on them as a safe haven are fading. Diversifying across multiple asset classes is your best bet right now.
That brings us to the end of today's episode. We've covered a lot, from the rising U.S. debt to bond market instability, and the expert opinions that highlight the risks and opportunities in today's financial landscape.
The key takeaway is this. The market is changing rapidly, and the strategies that worked a few years ago might not work today. Whether it's moving into safe haven assets like gold, considering TIPS, or exploring defensive sectors, diversification is the name of the game. Staying ahead of the curve means being proactive and adaptable.
And don't forget, even though the debt crisis and inflation pressures are creating challenges, there are always opportunities. As the experts reminded us today, investors who can stay flexible, diversify, and hedge their portfolios will be in the best position to weather whatever comes next.
Exactly. The key is to stay informed, adjust your strategy as market conditions change, and don't be afraid to explore new avenues for protecting and growing your wealth.
Thanks to all our listeners for tuning in. Don't forget to subscribe to Finance Frontier for more insights on navigating these volatile markets. If you have any questions or topics for future episodes, reach out to us on social media using hashtag FinanceFrontierAI.
Stay safe, stay informed, and keep an eye on those markets. Thanks for joining us today, and we'll see you next time on Finance Frontier.
Before we close today's episode, a quick reminder: the content we discussed is for informational purposes only. Finance Frontier does not provide personalized financial advice, and all investment decisions should be made after consulting a qualified financial advisor. Markets are dynamic and can change rapidly, so always ensure your information is up to date.
The opinions expressed in this episode are those of the hosts and guests, and should not be construed as specific recommendations for individual investors. Remember, investing always involves risks, including the potential loss of principal. Past performance is not indicative of future results.
We also want to give a special thanks for the music you heard in today's episode. Our intro and outro track is Not Without the Rest by Twin Musicom, licensed under Creative Commons Attribution 4.0 license. You can find it on the YouTube audio library for free use in your own projects.
Copyright 2024 Finance Frontier. All rights reserved. The reproduction or distribution of this content without written permission is prohibited. Be sure to subscribe and follow us for more insights into navigating the evolving financial markets. See you next time.